Global finance appears instant, but beneath that speed lies an older machine, one built on trust, delay, and trapped money. You tap a screen, press send, and money seems to move across the planet in an instant. But that image is, for the most part, theater. A Nostro account is essentially a bank's own funds held at a foreign bank, denominated in that local market's currency. A Vostro account represents that same balance, but viewed from the other side. Your funds held by us. Nostro and Vostro represent the very same account, simply viewed from opposite sides. One bank records it as an asset, while the other records it as a liability. Correspondent banking is more than just messages passing between institutions. It functions as a network of pre-funded promises, where one bank holds money on another's books. When a New York bank sends value to Manila, no actual money moves. Instead, it depends on a correspondent bank that already holds pre-deposited funds locally within the country. What the customer sees is simply a wire transfer. But behind the scenes, the system sees an immobilized balance serving as a buffer. Banks don't have direct access to every foreign payment system, so Nostro and Vostro accounts emerged as the practical workaround to bridge that gap. Banks are required to pre-fund accounts in multiple currencies, which leaves capital sitting idle across different jurisdictions and earning little to no return. Every dollar sitting idle in a Nostro account is capital that cannot fund loans, investment, or productive activity. Idle liquidity is never truly free. As the network grows larger, banks must maintain more imbalances. And when the corridor becomes riskier, the cushion they are required to hold gets bigger as well. Large correspondent banks effectively become toll-keepers of global finance, holding balances, processing transactions, charging fees, and dictating terms to everyone else. Smaller banks are forced to purchase access at a premium, and losing even one correspondent relationship can collapse an entire payment corridor overnight. Regulators describe it as safety, yet what they have effectively tolerated is a model that concentrates power beneath the disguise of prudence. Following the 2008 crisis, global banks didn't merely tighten rules. They severed correspondent ties entirely, abandoning higher-risk jurisdictions because avoiding compliance proved simpler than managing it. Smaller banks and money transfer operators were squeezed out entirely, while high-friction corridors grew even more costly for those left behind. Countries at the margins of the international system paid more to move less, and were told this was simply the price of financial integrity. Yet the real price was exclusion. Those who control the balances ultimately control the flow, the access, and who gets to participate in global commerce on favorable terms. The Nostro and Vostro model reveals a deeper truth about how finance actually works. It isn't really about moving money. It's about where money sits and who gets paid while it waits. When a new system can transfer value without requiring capital to be parked in advance, the entire economics of correspondent banking begins to wobble. When liquidity can be sourced on demand rather than warehoused everywhere, the traditional toll-keepers begin to lose their grip on global payments. When cross-border settlement becomes faster, cheaper, and less bilateral, it calls into question the entire logic of the current system. The true cost goes beyond the transfer fee. It's the opportunity cost of capital sitting idle across jurisdictions, earning nothing. For large global banks, these costs remain manageable. But for smaller banks and emerging market institutions, they can be absolutely crippling. Once the hierarchy becomes clear, it's easy to see why so many new payment and tokenization projects are now attempting to break it. Can centralized hierarchies sustain themselves amid the evolution of decentralized blockchains? That is the question the next part of this series takes on. If you want to explore how emerging payment rails might reshape the Nostro and Vostro hierarchy, subscribe on Substack for the next 3-part deep dive.